Hello everyone, this is Dr. Nagesha HG, Associate Professor, Department of Management Sciences, MIT, Mysore. One of the finance subject is for MBA third semester student, Investment Management. The subject code is 18 MBA FM 302. So first unit speaks about the basic elements and attributes of investment. So let us understand first that. So there are so many concepts here. First one, investment meaning, then investment attributes we are going to understand. Simultaneously, economic investment versus financial investment, investment and speculation, essential features of good investment, then investment process. Later on, we are going to understand financial instruments. Okay, these are all the basic components in the first unit. Along with this, we are having other that I will do it in the next session. So first one, investment. So what do you mean by investment? Investment is an employment of funds on various assets with the aim of earning income or capital appreciation. So it is a monetary commitment. So before we invest the money, we should have a monetary commitment. That monetary commitment should generate the financial return. For example, if a person commitment to buy a site or a house for his personal use, it may be an investment from his point, but this cannot be same for the actual investment. In the actual investment, there should be a financial return. Then only we call it as it is an actual investment. So actual investment is different and the general investment is different. So if you buy a flat or a house, this is called as general investment, whereas if you invest the money in securities or maybe in some kind of deposits, that is called as like actual investment. So before we understand the in-depth of that, let us understand the investment attributes first. Investment attributes are the components of investment. Investment attributes are components of investment. So here there are so many components we have to understand. They are risk, return, time, liquidity and convenience. These are all the investment components or attributes. The first one, what is risk? Risk is a possibility of loss occurs in the future. Risk is a possibility of loss occurs in the future. So before we invest the money, we should aware about the risk factor. If there is a higher risk, maybe high return. If there is a less risk, maybe a less return. So based on that concept, we start investing the money. So we should aware of the risk factor. Then return. Return is minimum required rate of return. So it should be there. So if you invest today 10,000 rupees, so how much you get in the next year? So it should be there in terms of percentage, maybe 10% or 20%. So we should aware of that. So how much percentage of rate of return I will get it after a particular period or a specified period. Then time. Time is a maturity period. So if you invest money today in the zero here, so when you will get back your investment and when you start earning the return, that is called as time. So there should be a maturity period for the investment. Then liquidity. So liquidity means like whenever you want to convert the particular investment or deposit into cash, so that should be available in the investment attributes. So the liquidity means like the marketable securities are easily convertible into cash within a short span of 1 year. So whenever you want money for your personal purpose or a general purpose, so it should be like convertible into cash. That should be there in the investment component. Then we have liquidity. So liquidity means convenience. So convenience means like here we are having different modes of investment. So based on our income level, based on our capacity, we invest the money. So it should be convenient. So you can choose either stock market or you may choose bank deposits or a post office deposit. Based on our income level and based on our financial capacity, we invest the money. That should be there in the investment attributes. So these are all the investment attributes. They are first one risk, second one return, time, liquidity and the convenience. So 5 attributes we have to understand. Next, moving on to difference between economic investment and the financial investment. So economic investment means like it's a general investment. So like it's an investment on tangible capital stock. For example, if you invest the money on building, purchase of building, land, equipment, machinery, inventories. These are all the investments are called as economic investment. So it is on the tangible assets. Whereas financial investment refers investment on stock, marketable securities like bonds, shares and real estate. These are all the things we call it as financial investment. So financial investment concept we are going to understand in the whole subject. So this is the difference between economic investment and the financial investment. I hope you understood. Then moving on to difference between investment and the speculation. So investment is different and the speculation is different. So but these two are correlated. These two are correlated. So we can understand the difference between investment and the speculation in terms of different nature. So we are having time horizon, we have risk, we have return, we have decision and we have funds. In that first one, time horizon. So time horizon means like usually the investment plan for a longer time horizon. Okay, so generally the holding period of investment vary from 1 year to few years. Whereas speculation time horizon plan for very short period. It varies from few days to a month. That is called as speculation. And if you take the risk factor in the investment, like it assumes moderate risk, whereas in the speculation willing to undertake the high risk, that is called as speculation. And if you take return has a difference, in the investment it likes to have moderate rate of return that associated with the limited risk, whereas in the speculation it like to have high return for assuming high risk in the speculation. And if you take decision factor as a different, usually in the investment, investors considers fundamental factors before he invests the money. So he evaluate the company performance regularly, periodically he scrutinize the financial performance of the company, then he will invest the money. Whereas in the speculation, the investor considers like the market behavior, inside the market information he collects and he invests the money. So based on the market trend, market behavior, he invests the money, that is called as speculation. Then when you take funds if you take as a different, so usually in the investment investor uses own fund and he tries to avoid borrowed fund. Whereas in the speculation, investor uses borrowed fund instead of own fund. So he borrow from somewhere, then he invests the money. So in the speculation, he should aware about the rate of return. The rate of return, whatever he get it from the investment, that should be more than whatever he has borrowed from the bank or any other sources. So that should be there in the speculation. But in the investment, only we use our own fund and we invest and we get back our money. That is called as investment. This is how we categorize the investment as well as speculation. Okay, fine. Next concept is essential features of a good investment. There are so many characteristics of a good investment. So if it is good investment, it should have all these quality. Then only we call it as it's an investment. So they are safety, first one, safety of principal, then liquidity, then stable income, capital growth, tax implication, stability of purchasing power and legality. So these are all the essential features of a good investment. First one, safety. Safety means safety of principal. Safety of principal means, so whatever you invest in the zero here on any mode of investment, that principal amount should be safer. Okay, so if you are investing a money of 10,000 rupees in a bank or any shades or a debenture, that particular amount, your money should be safer. So you should have that mindset, you should have that planning, then only you will yield very good return. Okay, next one, liquidity. Liquidity means investment should be convertible into a cash. So whatever you have done deposit, so whenever you want money, that can be easily convertible into cash. So based on the requirement, it should be convertible into cash. That's also one of the point we have to observe. Next, stable income. Stable income means your investment must generate a minimum rate of return over a period of time. For example, if you are investing the money for 5 years, every year it should have a particular yield, it should have a particular fixed return. So then only we invest the money. So it may goes up or it may comes down, but you should have a minimum actual fixed return. Then only the investment is good. Then capital growth. Capital growth means, so your 0 year investment, that is present value, and the upcoming year value. Okay, if you compare these future value and the present value, future value should be more than the present value. That is called as capital growth. Next, tax implication. This concept applicable to tax payers like salaried employee, those who are working for a corporate or a company institution, for them it is applicable. So, in order to avail the tax benefit, investors invest the money in various sources of investment. So, you may go for banks or a post office or shares or mutual fund. So, based on the tax percentage, tax slab, he try to invest the money in order to avoid the tax payment. That is called as tax implication. That is also one of the good quality of the investment. Then stability of purchasing power. Stability of purchasing power means there should be a continuity of investment. So, even though you get loss or a profit, there should be continuity, like some people do. Whenever they get profit, they invest the money. So, if they get loss, they do not invest. So, they will be having such kind of mindset. It should not be there in the investment. So, it should be a continuity, it should be regular, then only you are the very good investor. Then lastly, we have legality. So, legality means like rules and regulation we have to follow. So, if you want to invest the money in a bank, there are certain rules. If you want to invest the money in the security market, there are so many rules from SEBI, Security Exchange Board of India. So, based on the rules and regulation, we are going to invest the money. So, we cannot invest as per our ways. We have to invest the money as per the government norms and the regulation. So, these are all the general features or characteristics of good investment. I hope you understood. So, next moving on to investment process. So, every investor has to invest the money according to these process, these steps. There are several steps here. Steps start from investment policy and end with portfolio evaluation. In between we have investment analysis, investment valuation and portfolio construction. Okay, these are all the steps we have to follow in the investment. First one, what do you mean by investment policy? Investment policy means like rules and regulations of the investment should be known to the investor. So, we should aware of the rules and regulation of the investment. So, if you are investing the money in the stock market, you should know the norms. If you want to invest the money in the bank, you should know the norms. That is called as investment policy. Policy means it is a set of rules and regulation. So, it contains three concepts. They are investable fund, objectives and the knowledge. So, what do you mean by investable fund? Investable fund means whatever you are investing the money, that particular investable fund, whether it is owned fund or borrowed fund. So, we should particular about that. If it is own fund, so you may have different alternatives, like you may invest the money wherever you want because it is your own money. And if it is borrowed fund, the category is different. So, you have to select the maximum return of the investment mode because you are paying the interest to someone because you have borrowed from somewhere, then you are investing the money. That case is different. So, your rate of return in the investment should be more than your bank loan or maybe the loan from others. So, that is called as investable fund. So, investable fund may be owned fund or a borrowed fund. Cases are different in both the cases. Next, objective. So, objectives mean the investor should know the objective of the investment. So, that we categorize in terms of types of investor. For example, based on the risk, we categorize the investors into risk taker and the risk averse. If they are a risk taker investors, so they may go with more risk and the more return. So, they want more return, so they will invest the money even though the risk factor is high. And if it is investors are risk averse, so they want moderate return with the minimum investment. So, they want to take less risk and the return may be a moderate. So, that objective is different. So, based on the type of investors, we have a objective. Next, knowledge. Knowledge means investors should have a knowledge about the stock market. So, before he invests the money, he should know the certain principles of stock market. So, maybe currently stock market is under bull market stage or maybe it is under bear market stage or maybe a lambda. So, maybe currently inflation rate is high or deflation rate is low. So, there are so many economic conditions. So, we have to understand the economic condition. So, knowledge means we must aware of the stock market market behavior, then only we can invest the money. So, these are all the three attributes should be there in the investment policy. Next, moving on to investment analysis. So, investment analysis means examining the investment. So, once we know the rules, we have to examine, we have to appraise the investment, that is called as investment analysis. So, before we invest the money, we have to analyze carefully. So, analysis which contain market analysis, industry analysis and company analysis. What is market analysis? Market analysis means, so before we invest the money, we study about the market. We study about the market. So, for example, if you are investing the money in the bank, so bank market should be studied. And if you are investing the money in the stock market behavior should be studied. So, what is the market capitalization rate? What is the net profit? So, we have to study the behavior of the market. So, based on that, we invest the money. Okay. Then secondly, we have industry. Industry means, so if you are choosing the company, that companies belong to which type of industry we have to understand. So, maybe it is belong to software, or maybe it is food industry, or maybe it is any other type of industry. So, you should know the industry background. So, when the industry was originated, so when like industry developed, the growth of the industry, and the industry growth rate to the GDP development, how it is contributing to the GDP and how it is contributing to the Indian economic development. So, industry study must be there. Then company means actual company where you are investing the money, that is should be analyzed. So, company background, profitability of the company, capital structure of the company, okay. Then the like the previous year capital formation, how they have done it. So, those things should be known to the customer before they invest the money. So, we have to analyze in terms of these three concepts. They are market analysis, industry analysis and company analysis. This is the second stage. First one investment policy, second one investment analysis. Next, moving on to investment valuation. Valuation means here the investor evaluating the value of the asset or value of the stock. For that we call it as investment valuation. So, the value of the stock or the value of the asset should be known to the investor. So, then only we invest. So, without knowing the value, we do not invest. It should yield some return, then only we invest the money. So, the valuation can be done in terms of two forms. They are intrinsic value and second one future value. Intrinsic value means here the value of the stock is calculated by taking book value as well as price earning ratio. Based on the book value and price earning ratio, based on two things, book value and price earning, we evaluate the value of the stock or asset, that is called as intrinsic value. Then future value means the value of the stock will be calculated by using simple statistical tool. They are trend percentage or a trend analysis. By using the trend percentage, we evaluate the value of the stock. So, last year how much we had, currently how much we are having, next year how much we will have. So, such kind of calculation must be there, that is called as future value. So, we evaluate the investment in terms of intrinsic and future value. Next, moving on to portfolio construction. Portfolio construction means combination of the investment. Combination of investment is called as portfolio construction. So, here we are combining the investment. So, we are having so many alternative of the investment. So, we can choose different alternative of the investment. So, one investment may have the moderate return, another one may be a higher one, another one may be a less. Okay, so we are having so many alternatives. So, we invest wherever it is possible. So, maybe we allocate in a different way, then we will get the return. So, for that we call it as portfolio construction. So, we should have a more alternative. The combination of the investment is called as portfolio construction, which contain diversification, selection and the allocation. What is diversification? Diversification means like instead of investing the money in one sources, you select different sources for the investment. So, mutually we invest, that is called as mutual fund. So, portfolio construction of diversification happens usually in the mutual fund. Instead of investing the money in one particular unit, we are investing the money in different types of unit, and maybe one unit gets loss, another units may get profit. So, that is called as diversification. Then selection. Selection means in the mutual investment, so one may yields high return, one may yields less return. So, we select the best one, whichever maximize the return, that investment we take it. then that is called a selection. The next one is allocation. So allocation means wherever we have high return, for that we allocate maximum fund, that is called as allocation. These are all the things we understand in the portfolio construction. Next, the last one, portfolio evaluation. Portfolio evaluation means the valuation of combination of investment is called as portfolio evaluation, or appraisal of combination of investment is called as portfolio evaluation. So here we have appraisal and the revision. So appraisal means we examine the different types of investment. So which is good and which is not good, that is called as portfolio evaluation appraisal. Revision means wherever we have a maximum return, that we repeat again, that is called as revision. So these are all the two mode comes under portfolio evaluation. So these are all the steps of investment process. So we have to come up with first one, investment policy, simultaneously investment analysis, investment valuation, portfolio construction and portfolio evaluation. I hope you understood. So next, moving on to another concept, financial instruments. Financial instruments. So what do you mean by financial instrument? Financial instruments are modes of financial return. Modes of financial return or sources of financial return is, we call it as financial instrument. So financial instruments can be understandable in terms of different financial market, in terms of different financial market. So we have different financial market. So they are, first one, a money market, second one is capital market, third one is derivatives. These are the financial market. So we can understand the financial instruments in terms of financial market. First one, money market instrument. Money market instruments means, so before we understand the money market instrument, let us understand about the money market. So what do you mean by money market? So money market which deals with short term funds and the borrowing. So wherever there are short term funds and borrowing, so for that we call it as money market. So money market usually has like short term funds and the borrowing. So less than 1 year, whatever we have investment, whatever we have a borrowings, that is belong to money market. So in that we have several instruments. Then next one, capital market instrument. So capital market means which deals long term funds and the borrowing. So wherever the investments and borrowings are more than 1 year, so those investments are comes under capital market. So there are so many instruments in the capital market also. Then derivatives means buying and selling of underlying assets. Buying and selling of underlying assets are called as derivatives. So here also we have so many instruments. So instruments of money market, capital market and derivative markets will be understandable in the next session. Thank you so much.